Alright guys, welcome back. Now, chapter 12 is still dealing with merchandise inventory and the merchandising accounting cycle areas, but now we're going to talk about this is where it gets into the formal reports or the formal financial statements of income statements, statement of owner's equity, and balance sheet. Now, the one thing is I need to tell y'all is that they're going to be more in depth for the income statement and the balance sheet now, because they're dealing with long-term mortgage payables as well as dealing with calculating the cost of goods sold, net purchases, and anything that deals with the purchases itself or the cost of it. So let's go ahead and get started on this. Now, like I've already said, it's going to be going over all three of those financial statements. Now, the only thing is that the classified balance sheet is just a more in-depth or more itemized balance sheet, so you know what is where and how much it is being caught, how much it is in value. Same thing with income statement. It's going to calculate a lot more of what is inside of basically what goes into the whole process of the merchandise inventory. Meaning, you know what your cost of goods sold is, how much you've purchased returns and allowances, how much your customers have returned back to you, and what discounts you honored to your customers, and what your vendors honored to you. So it gives you all the in-depth analysis of the functions of the amounts inside your business, basically. Now here's an example of the new version of the income statement. Now, basically all it is just a bunch of subtotal columns, and then the last far right column, is the totals. The total areas are where you put your final numbers and you calculate downward. Now usually the first two columns deal with just calculating your cost of goods sold, as shown here. They show you your beginning merchandise inventory of that $19,000 from the last time we showed you in the other PowerPoint from the last video, along with your additional purchases and any discounts and any returns that you did. And since purchase returns and purchase discounts are contra cost accounts to your purchase account, which purchase account is the cost account labeling in this class, they subtract against each other. So you're going to take the $52,000 minus that total amount of purchase discount and purchase returns and allowances to get you your net purchases. You then would add that cost or that expense of freight, because freight is an expense to show that you invested that amount of money to get all that purchases to your location of where you resell, to then get the total amount of how much it cost, or your investment of how much you got for those purchases to resell to your customers. And you're going to take that with your beginning inventory that you initially started out with, from your beginning of starting off to what you purchased throughout that month, to get your total amount. You're then going to take, again, that ending inventory minus what was available for sale, to then get your difference of how much you've actually sold to your customers. Then you take your amount of sales that you have up here minus your sales returns and sales discounts. Now again, sales returns and sales discounts are contra revenue accounts to your sales or your revenue. Now revenue is the money that you've earned for your business. So basically, contra revenue meaning that the amount of revenue you lost, or money that you didn't earn anymore because either a customer returned items to you, or they paid you early, so you honor them with a discount. So they paid you less than what they initially were charged. So then you take your net sales, or the raw amount of how much you've actually earned from selling, and you subtract that from your cost of goods sold, which is the amount that you sold, hence the words cost of goods sold, the amount that you sold, that amount that it cost for you to buy that from a vendor to resell that, you take that against how much you sold it for, to get your actual profits, to get how much money you actually have to spend or reinvest into your business to keep going and keep functioning with accounting. Now, in the income statement, it's going to be going into different operating expenses, where it goes with selling expenses and administrative expenses. Now, it's just basically itemizing all your expenses into certain areas. So, if anything, you're going to have the only one you're going to have that's going to be away from everything else would be anything that deals with your mortgage or any what do you say? Yeah, I think it's just your mortgage. So if you look down at this video, at this portion here, you're going to notice that it says other expenses, interest expense. Now, I believe this interest expense will either be dealing with your insurance or for that interest on your mortgage. So this is the amount that you're actually having to spend out to pay either for that mortgage or for that insurance expense. And then you have all your other operating expenses, meaning you have what money you put into your business to keep it functioning, which is that insurance expense, supplies expense, depreciation expense on your store equipment, and any salaries that you have for your employees, the payroll taxes that you're deducting from those employees, and then any other expenses that you're dealing with, as in transferring, sending things back to vendors, sending things to and from other stores, and any other small expenses that you have to keep the functioning of your business. And then other income would just basically be that rent income that we talked about last video, where it means when you have a building that you're renting out third party, like that's your own building that you own, and you're renting it out to somebody else, where they pay you in advance and you earn that rent from them every month. Even though they paid you in advance, you still haven't earned any of that money. So if they pay you 4 months in advance and it's only been 1 month, 1 month has passed, you still are liable for 3 months of rent. Like, that money's still not yours. So you can't spend that money until you've earned that money and those months have come past and you've actually earned it to where it's not a liability anymore. It'll actually be an asset. And that goes for every month. So if it's $200 a month for 4 months, you got 2, 4, 6, 8. It's only been 1 month, so you have $200 that you've gotten so far. And you're still probably liable for the other $600. Now again, with the interest expense, it's more than likely going to be with that mortgage. So they're going to just throw in a little small mortgage here at the end of this chapter, where it's going to dealing with long-term and short, like current mortgage payment, and then a long-term liability, meaning it'll be that mortgage for that. And we will get into that in the coming up areas, where I will be showing how to put it into your worksheet. But we're going to go ahead and go over the PowerPoint first. Now, the income statement shows the total amount of what you earned, if you've made money or if you lost money. And now remember, all three formal reports need each other. So the income statement, whatever comes out of the income statement, needs to go to the statement of owner's equity. Now, the statement of owner's equity is to show any financial changes within your capital, to show any increase or decrease within it. Now, let me see if I give you a physical example here. Let me zoom that in just so y'all can see it a little bit better. Is that it's showing any increase that you've had for your capital. Now, you started off with $7,905 of value in your capital. That's how much you invested in the beginning of the month. So during this example here, they're showing that you earned, or you had a gain or net income of $13,745. So that means you've increased your value of your business by that much. But there's always going to be some deductions in the sense of withdrawals. Now, that's the difference that happens between the worksheet and this chapter, where in the worksheet it leaves withdrawals inside your balance sheet, where that's not really what you're supposed to do in the formal reports. The formal reports will break it up more into detail, and it doesn't go the same route as that worksheet. Now, The withdrawals will always be found inside your statement of owner's equity formal statement, which is the second formal report that you're going to be calculating once you get to that point in this assignment. And you'll deduct those withdrawals from any net income that you've done. Once you subtract that, anything that's left will then be your increase in capital or your increase in value of your business. So you add that to your beginning capital to get your new capital for the next month. Go ahead and zoom this back out. And now the classified balance sheet is, again, a detailed or itemized area to show all your assets and liabilities in great detail. So what I mean by that is going to turn it into current assets, fixed assets, and then current liabilities and long-term liabilities. Now let me see if it shows. Now, current assets that the book gives you is that basically it's anything that you can turn over within 1 year, meaning that you're going to use it within a year, or it can be liquidated or sold right away for extra cash if need be. So if you have a truck that you're using, a delivery truck that you're using, if need be, you could sell that truck right off the bat and then get your money back so you could keep functioning with your business. Even though you're losing something like an asset of a truck, you're still gaining money or keeping that sense of security with that money that you got from liquidating that vehicle. Now, current assets in here, we're going to be dealing mainly with cash, petty cash, accounts receivable, merchandise inventory, supplies, and prepaid insurance. So now a better example that I can give you for liquidity and a current asset would probably be your merchandise inventory. So for example, if we're Walmart and our current assets deal with a lot of toys, we could then liquidate those toys or sell them either to another small business or just sell them for a really cheap price just to get rid of them. That's what it means when it's talking about liquidity, on how quickly or how fast you can get rid of that asset. Basically meaning like if you take a bottle of water and just pour it over, like you can get rid of it that fast by just pouring that water over out of a cup. That's how fast you can basically transfer that money out from one account to the next. So if you sold all $4,000 worth of merchandise inventory, you could then gain $4,000 of cash just like that. Now, long-lived assets is the other area of the asset area. That only means equipment, buildings, and land. So long-lived assets meaning that you're going to hold them for a long time. So like that delivery truck that I was talking about, that delivery truck you wouldn't want to sell it right away because that's a very valuable functioning piece of your business. That's basically that's one of your main structures to keep your business functioning. So you can't get rid of a delivery truck just like that because you either have payments with it, you don't own that vehicle all the way because maybe you're still doing payments with the dealership. So it's a long-lived asset where you basically have that. The only thing with that is that equipment has depreciation or devaluation over time. The one thing that doesn't show depreciation or devaluation over time is land. Land will always be valuable, will be valuable inside a business's life. It will always be valued, if not increasing in value. Now, your building is basically just on your land, so it's the same thing. You're going to have that long-lived section of keeping functioning within those assets. And this is the way they're going to show it in here. Now, there's three separate columns to the balance sheet. The first one is going to show all the subtotals of any assets and liabilities. The middle column will show the final totals to those numbers, and I believe the last column will show the two final numbers for your assets and liabilities. So now current liabilities will deal with any current payments that you have. So when I talked about that current mortgage payable due, if you look at your assignment 12A3, and I'll show it up right here. You're going to have to yell at clause again because it's sideways. You're going to get a crick in your neck. I already have one. Where is it? On the top here, it's going to show on the parentheses note the amount of mortgage due the first year is $890. So that first mortgage payable, that payment for $890 is a current liability. So that amount will have to be labeled inside the current liabilities area with anything else that you have. So it'll probably be mortgage payable, current liabilities, or like accounts payable for any of your vendors, and that's probably about it. Like, there's not a whole lot of current liabilities that you can have with that. Another one will probably be unearned revenue, which is unearned rent, which will probably be somewhere underneath either other liabilities or right underneath there under current liabilities. And in addition to those other liabilities, the main thing that's going to show up, see, there's the unearned rent right there at the very bottom. That's a liability because you haven't earned that amount. Now the rest of these are dealing with basically any deductions that you take from your employees. Now this is where I was telling you all in the last video where you're going to be dealing with some payroll aspects of accounting. Again, for this last chapter. The last chapter is going to bring in every single thing, if not. I don't think they're going to bring in petty cash in here, but they will bring in the payrolls in the sense of recording them in the general journals and in the balance sheet, just like so. So don't get confused on debits and credits in the balance sheet or the financial statements. There will always be a left side. There will always be a subtotal and totals area. You're always going to find that in these new formal reports. The only one that wouldn't have that would have been the income statement from the beginning. But now that the income statement has become more in-depth and itemized, there's nothing in regards to a subtotal and total area. So always remember that. The three formal reports or financial statements will only have subtotals and totals, and subtotals to those subtotals, meaning that you have your smaller numbers to add up to bigger numbers that you're then going to add up to the final numbers. And we're going to get into that in a bit, so bear with me, please. Now, the long-term liabilities is basically going to be only that mortgage payable. Basically, anything else that you're still owing in that. So I believe, let me check and see here. In the assignment, it's going to show, let's see, mortgage payable. In the assignment, it shows that you have $1,260 in total of mortgage payable. Now, it tells you in the assignment in note that you're going to pay $890 for your current payment, your current liability payment. That means you still have a certain amount that's still left over to still pay. That remainder from that $1,260 minus that $890 will be your long-term liability amount. So if you don't include that in your balance sheet, you're then going to be off by a certain amount and you're not going to balance in that balance sheet, okay? So you need to be sure that you know that there's going to be that current liability, that's going to be that payment, that mortgage payment due, and then you have to put the remainder of that number in the long-term liabilities area, because that's still going to be done, hasn't been paid off, and it's going to be paid off later on in the years as you work. So as shown here, it's going to show you here that current portion for that mortgage payable, for this example here in this book, for the PowerPoint, it's $320. And then the remainder for that is going to be $2,000 as shown here on this section. Now, mortgage payable shows that subtotal area here of $2,000, not in this first column because it's already just like a final number. It's a final number to another number. And you just basically, for your current liabilities, you're taking all the subtotals to all your payables, basically everything that you owe to either the government, to your vendors, or to your bank and employees. You need to subtotal all those and then total amount to then balance out to see if your assets and liabilities equal each other out in the balance sheet. Now, for this assignment that you're going to be going over, you're going to have to then journalize the adjusting entries and the closing entries for the assignments, both in your ledgers and your journals. I believe they give you ledgers. Let me double check that. Okay, they don't give you ledgers, so it'll just be giving the closing entries in the general journal. You're going to show the adjusting and closing entries, which I'll give some brief example on if it doesn't show it here. So it shows it here, so I won't have to basically tell you or show it to you as much on that assignment sheet. Now, for your adjusting entries, it's going to show here that it's going to be dealing with that income summary again. Now remember, what the income summary does on that worksheet is basically it's only going to show you the transfer from a beginning inventory to your ending inventory. So if I go ahead and go to here, your assignments, it's showing that we initially had $11,200 in our beginning inventory. But we don't have that anymore. We're ending our inventory with $10,600. So we first have to get rid of $11,200. What you would do is then debit that into income summary to get rid of it out of your merchandise inventory. So then you would credit first. So first you debit into income summary, then credit out of merchandise inventory to zero that out to zero. Then you're going to then debit your ending inventory or your new inventory into that merchandise inventory account, and then credit into income summary so that it'll balance and showing the functionality of you getting a new or ending inventory. And it just follows the same thing of whatever you did here on the worksheet, you're then going to reflect on your general journals as shown here, like they're doing here for every single one of their adjustments. And that should be fairly easy because it's something that we've already done and we should remember. But I will go through it again once we get to that assignment. Let me go ahead and just scroll through this real quick. So now, you also have to, again, like I said, you have to do the adjusting and then also the closing entries. Now the closing entries, you're going to have to get rid of or basically close your temporary accounts. Now your temporary accounts, when you're closing your accounts, are going to be revenue, expenses, and withdrawals. And also technically income summary. Now the process of this happening, if I can figure this out, let me see. I'm going to go ahead and do this on the second journal. Let me go ahead and color code this real quick just so we can have some variety in here. It's not just black and white. So the process of actually closing out your temporary accounts will then to be showing, basically, let's first start out with your revenue. So then you would debit basically all your revenue accounts. Let me see, what did they have here? Closings. So you would first initially close all your revenue accounts, which would be sales, training fees earned, purchase returns, returns and allowance, and purchase discount. Now, you're probably asking why purchase discount and why purchase returns and allowance for our revenue accounts. Because purchase returns and allowance and purchase discounts show money that you saved from investing into your costs of purchasing items to resell. So you have to remember that purchases is when you buy stuff on account and you owe that amount of money. So when you return those purchases back to your vendor and then they give you a discount in other transactions, that shows that you saved that amount of money. Yeah, that's basically it. You just save that amount of money. Like, that's it. And all these totals out, all these debits for these 4 accounts. Oops, let me do that in another color. Those accounts will then be credited into income summary. And now basically what this is showing is that you're doing the opposite of what these normal balances were. So the normal balance for a revenue account, or the increasing side for a revenue account, is credit. So when you're trying to close it, you're going to debit them out, to zero them out. And then once you do that, you're then going to credit or show that amount of money into income summary. And that could be an X amount of figures. Okay? Now, this is basically going to be the same thing as basically what's happening in your income statement formal report, because you're showing the amount of revenue inside your income summary minus all your expenses. So then what you're going to have to do is then you're going to have to debit income summary to all those credited expense accounts. So basically all your expense accounts would be sales returns and allowances, sales discounts, purchases, freight in, because that's how much it cost us to get that stuff in there, so that's money leaving the business, advertising expense, the amount that we used to promote our business, so money that we spent, rent expense, we have to pay the bills, salaries expense, to show that we're still paying our employees, depreciation expense for equipment, and finally insurance expense. So the amount for all of these, let me see, all the credit amounted for these will then be debited into this area. Now, for the most part, your credit side should be the greater number to this number. Now, when it does that, it should then be on the credit side, because whatever number is greater will then become your normal balance for the income summary. Now, what I mean by that is because the income statement is basically the same thing as what we're doing here in this area, where you're taking your revenue minus your expenses and then determining whether or not you have a net income or a net loss. So if this number here, your credit number, is greater than this, your debit number, your expenses, you'll then have a net income of whatever amount it is. And then once you have that amount, it should be labeled on the credit side. So then when you close out the income summary, you're then going to debit the income summary by the amount. So I'm going to give you a small hint here that it's going to be somewhere in the amounts of this number. And then you would then credit that into capital. that same number. And then finally, you're going to have that last temporary account, which is going to be withdrawals. So then you're going to debit into capital whatever amount it is of withdrawals. I'll go ahead and give you this number. This number is going to be 43100 43100. And then you're going to credit it out of withdrawals because you're closing withdrawals. Now remember, withdrawals is like an expense account. It's showing money leaving the business. So it has an increase of a debit side. So then what you would have to do is then close that or credit it and then debit it into capital. So now you have these two numbers that are inside that same account. Now notice how your credit side is greater than your debit side. So that shows that you're going to have an increase in capital. So once you take the difference between these two numbers, you'll then have your increase in capital, or the number, the amount that you're going to increase your value of your business by. And this is basically the same process as what you've done in your statement of owner's equity, which is going to be showing your beginning capital. I can spell. I can't spell. Beginning capital, and then plus your net income, minus or less any withdrawals to get your increase in capital, and then your new capital. Capital. Okay. Now, yes. So now, going back into your PowerPoint, it's basically showing the same thing that we just did. So the example here is showing that all those sales or those revenues being closed out into income summary. So this is all your revenues minus all your expenses, which are all these expenses totaled up to here. So these two numbers are inside your income summary T account. Basically the same thing that you have in your statement of inside your income statement, where you're subtracting your revenue minus expenses to get either a net income or a net loss. In this case, or for most cases, it's going to be a net income or a gain in money because your credit is increased. Now, since your credit is the bigger number, that will be your normal balance or the side that you will put the number on. And then when you close it, you will do the exact opposite, and then you would debit it out of income summary and credit it into capital to show that increase, that amount of increase in your capital. And then that final thing where you're going to have that closing of your withdrawal account, crediting your withdrawals, and debiting it into capital to get that mathematical equations out of the way. Now, if you look at these numbers here, this 13,745 and this 8,600, if I go back up and look at your income statements, if I look at your statement of owner's equity, right here, it's the exact same numbers. So now basically, all you're doing is just showing your formal reports inside your journals. That's what you're doing. You're just showing what you did in your formal reports inside your general journals or your place of original records, which is your general journals, so that you have those records in your reserves, so that in case the IRS comes in and be like, hey, I don't think you did these right, you can be like, no, I actually did them right. Here's my proof on showing that, so that you are square and that you don't get into any trouble. Okay? Now, back to where we were. Let's see. Yes, closing entries. So that just goes to show you on that they're not just doing this just to make you crazy, like, and pull your hair out. Like, it's actually doing the functions of processing everything so that you know what you're doing and that you have it right. Now, it talks about the post-closing trial balance here. Basically, after you've closed all your temporary accounts, which are revenue, expenses, and withdrawals, and in the case of income summary, once you've closed out all those temporary accounts, any account that still has a value in it will be placed into the trial balance, which will basically show all your accounts in their normal balance area, the debit, credit, so on and so forth, to see if your numbers match and that they're right. Like this. So basically, it's going to show all your assets and all your liabilities and owner's equity. But your owner's equity is your capital. Your liabilities are all your payables and your unearned rent as well. And your assets are going to be all your assets, which is cash, petty cash, accounts receivable, merchandise inventory, supplies, prepaid insurance, store equipment, and accumulated depreciation. This goes to show you that they balance and that you can move on to the next month and continue with your business. Now, reversing entries, I don't think I need to get into that. Reversing entries only deal with when you made an error, I believe. I think it's only when you made an error. Increase in liability, whatever way you discuss. Let me see. Reversing entries not used. Bookkeeper must refer back to the prior year adjusting entries. Reversing entries not used on expense. So yeah, I think that I wanted to go over that for now. You should be fine with that. You're not going to deal with that in the chapter. So then let's go ahead and get started with your worksheet. Let's see here. So now, you basically know the processes of doing the worksheet itself. So I'm not going to go into that again, because you've already have chapter 11 that I've demonstrated for you, so that should be more than enough for y'all to do this work for you. So I'm just going to show you what you have to do in journalizing these entries like I did for the closing, but I'm going to use these actual numbers this time. Okay? And then I'll also give you the information that you need for these formal statements, like how to format and how to show your accounts on the side. So, starting off with your adjusting entries, our first adjusting entry is dealing with that merchandise inventory, where we're showing the beginning inventory that we don't have anymore, and now we have a new inventory or ending inventory that we're having to adjust because of the end of the month. It's the end of the month. We need to show those numbers to be up to date. So for the adjusting entry that we have here in our worksheet, for transaction A is going to be $11,200 debited from income summary. So that's what we're going to do. We're going to come to our journal, and I believe, what month is this on? For the month of December. So at the end of the month, December 31st, you're going to debit income summary, because that's what we have in our rules of adjustments inside our worksheet. We're debiting income summary for $11,200. Okay, if you see that number, notice how that I put double zeros and then you press enter and it goes back to a single zero. What you're going to do is go ahead and highlight it, the whole column, hold control, click the other one, and then you're going to go here to this drop down arrow where it has number, and you're going to go ahead and press text, just so that you can have that fixed and you're not going crazy. Now, for every debit, there's a credit that must balance or equal the same thing. So you'll have a credit of $11,200, and you're crediting this out of merchandise inventory. Merchandise inventory. Hey, Carol. Give me 1 sec, folks. Pause. Okay, so just going back with that is that for the adjustment, you're just doing the exact same thing. You're just putting adjusting for ending inventory, You're just basically copying exactly what is in your worksheet. Whatever you see here, right here, should be reflected the way you see it from the worksheet. You should see it here. Okay, so this is only half of that first entry, meaning of this right here. We've done this right here. We've showed this debit and credit, or the leaving of the beginning inventory out of merchandise inventory account. So now the next one will show the entrance or the input of the new ending inventory balance, which is that $10,600. So we always start with our debits. So merchandise inventory is debited by $10,600. So then we're going to come over here on the 31st. You're going to merchandise inventory for that $10,600. And then for every debit, there has to be an equal credit. Oops. And then you're going to then credit income summary. Now these entries here will not necessarily affect what goes on later on in the closing entries. Your closing entries will be determined by what we've talked about already, which are the accounts that I have here for you already. So you should be fine with that. As long as your numbers are fine, as long as your numbers equal out and you balance out in your worksheet, your numbers on these should be just fine and you should work. Okay? So then continuing on with the adjusting entries. So we've already done A and B. Now C is dealing basically with your unearned training fees or your unearned revenue. So initially you have a debit in unearned training fees. So basically unearned training fees is like a liability, so you're decreasing your liability by that amount. So unearned training fees for the amount of $350. So you're debiting that $350. For every debit there's an equal credit. So then you're then going to credit, it'll come to me, you're going to then credit your training fees earned because you basically earned that amount. Now, like you have that amount for you. Like you've earned it. Like it's yours now. Training fees earned. That is your money. Your money. And then D, transaction D, you got your debit of depreciation expense for equipment So you're going to then go into your journal, 31st, depreciation, expense for your equipment, and you're going to credit accumulated equipment for that amount. Now the amount is going to be $370. So you're going to debit $370 and then credit $370. Now I'm pretty sure y'all get the gist on that right now. So I'm going to go ahead and advance off to the way your structure is going to be for the side entries, so y'all can put the numbers in here. So for your income statement will start off with your revenues, like it always is, which is revenues, with your gross sales, whatever amount you have for gross sales, minus or less sales return and allowance. Go ahead and abbreviate that. Allowance. As well as for your sales discounts. Because sales discount and sales returns and allowances are contra revenue accounts. They fight against the money that you earned. They go against it. To then get your net sales. And then you're going to have cost of goods sold. Cost of goods sold. You'll then have your merchandise inventory, part of that. Merch inventory. Now this will be for the beginning of the month, or 1-1X. And then you'll have purchases right underneath it, because that's the purchases that you've done during the month of that beginning inventory. You're then going to subtract or less any purchase returns, any returns that you did allow to your vendors because you didn't want any defective items, and then your purchase discount. Okay. To then get your net purchases. You're then going to also add in your freight in, because your freight in is part of the cost of to get those purchases into you. Get those purchases to you. To then get net costs, if I can spell. Cost of purchases. And then you're then going to total it out to cost of goods. Cost of goods available for sale. Minus merchandise inventory for your ending inventory. So 12, 31, 1X. That'll be at the end of the year. To then get your total cost of goods sold. To then get you your gross profits. Now that's dealing with your revenue side. Now the expenses side, you're going to have your operating expenses as the main title. And you're going to have all your expenses underneath that. Now if I can see if I can get this to be a lot simpler for y'all, is to see if I can get these here. Yes, it'll be all these right here. Up to insurance expense. Man, insurance expense is misspelled. Sorry to see that so late. but that's life. There, insurance expense, OCDs. Then you're going to have your total operating expenses. Then underneath that, you're going to have net income from operations. Now, net income from operations, this number will be on your final side over here. So I'll give that a little small little orange highlight so you know that that number will go there. And then, oh shoot, other income, your other sources of income. In this case, it'll be the training fees earned. Training fees earned, which will be a certain amount that will go under here, because that's the final number, to then get your total net income of whatever amount. Now this amount here, right here, I'm going to put this in yellow, this amount here should match the number that you get right here. Okay? Right there. Just a little hint, okay? Just a little hint. A little bit. A little one. Okay? So now, just a little, give a little highlight as well that these numbers will go here. Whatever amounts will go there. So then these two accounts here, these two will go here. To then be totaled out to here, where you'll take the math between these two. So this number will then come over here. The total of these two will come here, and then totaled out to here, so you can get your actual net sales. And then your beginning inventory will be labeled right here. Okay, there's going to be some subtotalings that will go through here. Your purchases right there. Your less, these two accounts will be subtotaled here, because it's a subtotal to this subtotal, to then be added here, to then get your actual net purchase number right there. You'll then also add that add freight in here. You can add that number there, to then move that number over here, the net cost of purchases here. You'll then do some more totaling out for this number. You'll get a new note. You'll get a new big number here, and then you're going to take your ending inventory, subtract it out of that right there, and then throw that final number over here as the cost of goods sold. You'll then do the math between this number and this number, subtracting those to get your gross profits. Okay? And then same thing with your operating expenses. You're going to have basically all these total out to this number. I'm sorry, this one here will not be there. It would be here. These total numbers will total out to this one, to then do some more math for this. You'll do your math from this number with this number to get this number, and then you add this number here, whatever that is, number for training fees, to get your final number. Okay? That's all I'm going to give you for that piece. Now I've already given you this area here. All you have to do is just find those numbers, plug them in so that they work. And finally, your balance sheet. Now your balance sheet is going to look like this, where your assets come first. Assets. Where your current assets. Now, current assets are then going to be where your current assets are going to be your cash. You know what? Let me go ahead and do a quick. I know it's alright. I can get this. Your cash, accounts receivable, merchandise inventory, and prepaid insurance. Then you're going to have your total number for current assets. You're then going to have your, in a sense, fixed assets or long-term assets. We're going to have your plant and equipment, which is just going to go down into just equipment, minus your accumulated depreciation, and then you're going to get that total number of assets. Total assets. Now with your total assets already finished out, you're then going to continue with your current assets. Current liabilities. If I know how to spell liabilities. Go ahead and center this. Let me center. There we go. So then your current liability. These will be liabilities. Then this one will be current liabilities. Oh, I hate this. So your mortgage payable. Remember, that's going to be that small amount, that $890 that will be placed there. Accounts payable. So let me go ahead and put that number in there for you so you know where that goes. This one. This will be right here, $890. Then you're going to have your number for accounts payable, whatever that amount is. Okay. Then you're going to have your unearned rent. Unearned training fees. And then this amount here would be total current liabilities. Then you're going to advance to your long-term liabilities. Which will basically be only the rest of that mortgage payable. Okay? So whatever that amount is that's left over from $890 minus that other number that's in your worksheet, this number will go here. Right here to be exact. Okay? And then your total liabilities will go on the far end. Total liabilities. And then finally, you're going to have owner's equity, where you're going to have your capital, which will go all the way to the end. that will add up with your total liability number. So you're going to have your total liability number with your total capital number to get a number that should balance with the other number up here for total assets. Okay, so then this number here will be your final number for total liabilities and owner's equity. Okay.
Last chance. You want one?
So then your total amounts for these, let's see, from here to here should equal out to here, to then be subtotaled with your total assets out of equipment and the depreciation. So your equipment and depreciation will take a calculation here to then be total asset from, so here this will be your final number between your two numbers here of equipment and depreciation. You're going to add this number and this number to get your final total asset. That should balance out to your last number at the very bottom right here, okay? And that should be it. Good luck, and may the accounting forces be with you.